In this session, let's focus on one more core element of the balance sheet, the non-current liabilities. We have already looked at the inventories part, the non-current assets, long-term assets part, and also the income taxes, deferred tax assets and liabilities. So let's look at the long-term liabilities part, where we are focusing on three major aspects here. One being the bonds. As a part of non-current liabilities, we'll try to understand the bonds. Two, we will look at leases. And three, we'll have a base understanding on pension liabilities. So these are the three major aspects we'll look at in this session. So starting off with the bond, whenever we are talking of a bond, here not investing in bonds, it's more of issuing bonds. Company raising capital through bonds. So it's like as good as a loan. Company raising capital in the form of bonds is as good as it is raising a loan. So the bond, as a characteristic of the bond, what we see is there is for every bond there is something called coupon, and there is something called maturity value, or even the face value. So coupon is something which the company pays every year. It is generally quoted in terms of percentage of the face value. Like when someone says 8% coupon bond, it means 8% of the face value of the bond is paid every year. It's just like, probably you may think of it as interest, but need not mean as interest all the time. It's some amount which the bond will pay as a regular fee. See, if you have taken a loan from me, right, the way you make the payment could be in such a way that you will pay something every year. Let's say you have borrowed some X amount from me for a 5-year period. It can so happen that you will do the repayment lump sum at the end of 5 years, just like what an FD does. I have taken a fixed deposit. They don't pay anything in the middle. The whole lump sum amount they pay at the end of 5 years. If I take a 5-year FD, right? That is one form. Whereas there could be some other instruments wherein every year some amount is being paid, and at the end of 5 years, a kind of a sizable principal amount is what is being paid. So there are different kinds of payment in terms of a loan. Either I can settle everything at the last, or I can settle some amount every year and remaining in the last. So whatever is that amount that is paid every year is what we call as coupon. In some cases it can be exactly equal to interest. In some cases it can be more than interest. In some cases it can be less than interest also. That's the reason we don't equate coupon to interest. Coupon, you have to look at it from a bond's perspective. Some amount which the bond is going to pay every year. So if I am saying 8% coupon bond, what it means to me is the borrower is going to pay 8% of the face value of the bond every year, and the face value on maturity. So typically when we talk about, if we understand this terminology, anyhow we will cover the same again in our fixed income securities also. But because that kind of understanding is required here itself, we can spend some time in terms of that understanding, so that there it becomes slightly easier for us. Whenever we hear the word coupon, right, there is always a misconception that it is equal to interest. That's not the case. These are two different words, because there could be a zero coupon bond also. It's a very common word which we use. zero coupon bond, it doesn't mean that the interest is zero there. It will still give some interest. The only thing is every year there is no constant payment. There is no payment every year. Everything is paid in lump sum on maturity. That is what is the meaning of a zero coupon. So coupon, you have to really understand it as some payment on a periodic basis, probably every year, some amount that is typically being paid. So whenever there is a question saying 8% coupon bond and the face value of the bond is 100, what it means is at the end of 1 year I will receive 8, 2 years I will receive 8, at the end of 3 years I will receive one more 8. So every year I will receive 8, and let's say this is a 5-year maturity bond. So in the 5th year I will receive 108. These are the typical payments which the bond will be making. Right? So always look, and if I say the same instead of this zero coupon bond. So at the end of first year 0 is paid, second year 0, this year 0, and probably 100 is being paid on maturity. Face value of the bond is generally paid on maturity. Any definition of the bond goes like that. The face value of the bond is generally paid on maturity. And if there is a coupon, that is something that is paid regularly at every period. Generally year or semi-year. For some kind of bonds, we always look at it as a semi-annual kind of stuff. So every 6 months. But the quoting is always on an annual basis. 8% semi-annual bond. It doesn't mean that for 6 months it is 8%. It means for 1 year it is 8%. So payments wise you look at it as 4% per 6 months. Right? Of course. So the calculations involving them we'll look at in our fixed income subject and the valuations of fixed income instrument. But just giving you a flavor because we need to understand the accounting or the reporting aspect of these bonds at this moment. So we need to see if this is the bond, how much I should show in the balance sheet, what should I show in the P&L. Over a 5 years, what numbers are shown for each of the periods. That is what is the most important aspect as far as financial reporting part is concerned. But to understand a bond instrument, the structure is always like this. You could have a zero coupon bond or you could have a coupon bond. Coupon is like a fixed payment. I mean, it could be floating also, but a regular payment at periodic intervals. Payment at periodic intervals, intermediate, not on the maturity. Intermediately, some payments are typically being made. Those are called as coupons. So, in general, they should be fixed coupons only. But nowadays, because of the advancements and all, you will find some floating coupons, all kinds of various instruments coming up. But a typical, even fixed income security, the meaning itself typically floats from this idea of fixed coupons, fixed face values or maturity values kind of stuff. Now, coming to the reporting aspect, what we will typically initially start off with is, okay, if this bond is having these kind of features, at what price is this bond currently sold at? The first aspect. Right? Now I'll see, this is the features of the bond. Now any purchaser of the bond will pay some price for it to purchase it. So let me say that this bond is purchased at probably 95 bucks. Right? If I say this bond is purchased at 95 bucks. So which means if you purchase one bond today by paying 95, this bond will give you 8 after 1 year, 8 after 2 years, 8 after 3 years, 8 after 4 and 108 after 5. Or probably let's say this zero coupon bond, you have purchased it at 70. So which means it's as good as an FD. You are paying 70 today. you will get 100 after 5 years, right? So if this is the case, so every bond, when you are representing them on the financial statements, you need to have these three details associated with the bond. One, what is the coupon associated with it? Two, what is the maturity period, in how many years it is maturing and at what amount? What is the face value which mature at the maturity date? How much is being paid on maturity? And three, at what price is it being sold at today? Once we have this three information, right, the first thing that goes into the financial statements is this number, the price at which you have purchased the bond. The price at which we have purchased the bond, at the time of purchase of the bond, we'll identify the price. 95 is the price here. Now, what we'll say is, by the extent of this 95, I will increase the assets and the liabilities. Why? I have sold a bond. Now I am looking at from a company which is issuing the bond. It's not who has invested in the bond. Which has issued the bond. It got cash, 95. 95 it has got as cash today, because you have purchased my bond. Means you have given me a cash of 95, which means the assets are going up by 95 for me. And I have to repay back to you, which means the liability is also going up by the extent of 95, because it's not my money, I got it in the form of a loan, right? So the assets are going up by 95, the liabilities are going up by 95. So whatever is the current purchase price on the date of purchase, whatever is the purchase price that is existing, by that much amount, both the assets as well as liabilities will go up, right, for that bond. These are the entries that typically get into the financial statements on the date of purchase of the bond or on the date of selling of the bond. Now I look at it from a company standpoint. On the date of issue of the bond, the assets and liabilities, both of them will go up by 95 as per this example. 95 is nothing but the price which is decided for a buy and a sell. And the money which the company is getting, that 95, goes into cash flow from financing activities. Whatever it has received, because it's a part of non-current liability, the cash flow statement wise, it goes into cash flow from financing activities. So those are the entries on the date of issue. Now, assume that it's a 5-year bond. So what do I show at the end of each year? At the end of each year, what is that amount I should show in balance sheet and probably in P&L? On the date of purchase, there is no P&L entry at all. Right? In the balance sheet, asset and liability, both of them are going up by 95. On the cash flow statement, cash flow from financing is increased by 95. No entry is made in the P&L statement. Now, what we want to see is, over the next 5 years, what are the various representations that come up? So, okay, at any point in time, if at all I want to find out what should be the balance sheet value of the bond. Today it is at 95, right? After 1 year, how much should I show it as? Should I still show it as 95 only, or should I show it as something else? For that, what the process we are following is, it will be the same for all kinds of the bond. The first step is, so for this bond, we'll show 70 as asset increase in assets and liabilities as on the date of sale. For each of them, find out the IRR, which is nothing but annual rate of interest which is applicable. Right? Here 8 is not the annual rate of interest at all. 8 is something which the bond is paying on a yearly basis. May or may not be equal to interest at all. right? It may be more than interest, it may be less than interest, it may be equal to interest. We'll see the scenarios also. May or may not be equal to interest at all. So coupon has to be seen different, interest has to be seen different. Interest is nothing but the IRR. The annual rate of interest for this bond is nothing but IRR. So using your calculator or something, if you are trying to find out the IRR for this bond, it is coming out, you see now, it is slightly more. 9.3% is the actual return which you are getting every year. 8 is what they are paying. But if you look at it as a package, you are actually receiving 9.3% every year. That's the first step. This is what is called as IRR or probably yield to maturity. These are some of the words which exist. We'll discuss them later also, but yield to maturity is the same name in case of bond. And I have to first compute this aspect. The same logic will hold true even for a zero coupon bond. Even for this zero coupon bond, yeah, this is typically paying around 7.39%, right? Okay. Now, once I know this information, what we are saying is the value of the bond. Now, the book value of the bond every year. What are the entries that go every year? Now, this information is available. That every year the rate of return is 9.3%. Now, what we will do is there are three aspects that will come up here. We'll look at one by one, which is the interest. Where does this interest expense go? In the income statement, P&L statement. There is an entry for interest expense. The interest expense in any year is 9.3% of the outstanding principal and 7.39% of the outstanding principal here. The interest part. Okay, so what is the interest part here? 9.3% times my outstanding principal is 95. So on 95, I will apply 9.3%. So the interest for this period is 8.83. So this is the entry that goes into the P&L statement in the first year. At the end of first year, 8.83, which is nothing but 9.3% times whatever is your amount that is outstanding. Right? 95 is the principal that is outstanding. And on that principal, we are computing 9.3% is the annual rate of return. Annual rate of return is 9.3%. So 9.3% on 9.95 is computed and is put as an interest. So which means here also, though it's a zero coupon bond, there is an interest that is coming in. What is the interest here? 7.39% times the 70. So 5.17 goes as the interest expense. Alright. Now, so these are the entries in the P&L statement. The first entry in the P&L statement every year is the interest expense, which is nothing but whatever is the annual rate of return, which is computed from the IRR, multiplied by whatever is the amount that is outstanding at the end of at the beginning of the year. 95 was the outstanding at the beginning of first year because you have taken 95. Right? Now, 8.83 is the interest. But what is the actual payment that came in first year? Only 8. Actually, 8.83 should come, but only 8 has come. So 0.83 is still outstanding. You add back that 0.83 to the outstanding part. To 95, you add back that 0.83 extra, which means for the beginning of the next year, The outstanding amount is 95.83. As of this year, the interest should be 8.83, which you should pay me. But you are paying me only 8 as a part of the coupon. So from my side, as someone as a borrower, I should pay you 8.83, but I am paying you only 8.83 is still outstanding from my side. Earlier 95 was outstanding. Now 0.83 is outstanding. Now what I am saying is outstanding at the end of the year is increased by 0.83. So what we are saying here, the loan liability, right? Now, okay, the difference is nothing but what is the interest minus what is the actual payment that is being received. So in this case 0.83 only, whereas in this case it is the whole amount. I did not receive anything. Zero coupon bond, so they did not pay me anything. So this much is outstanding. So what we are saying now, the loan liability for us is actually increased by this much extent. Loan liability is increased by this much because that's also outstanding now. From my perspective, even that is outstanding. So at the end of first year, this becomes 95.83, this becomes 75.17. You are getting this point? The interest, so these are the three entries that go. The first thing is I am looking at the interest expense every year, which is, so for the second year, what will happen now? For the second year, the interest expense is 9.3% of 95. Now the outstanding part is 95.83. The interest expense for the second year is this much. Similarly, the interest expense for this year is 7.39% times. This is the new outstanding. So in the second year, these are my P&L entries. Right? Okay, 8.9 is outstanding. But I am still paying 8 only in the second year. So the remaining is still getting added up to the outstanding. So the difference again in this case is 8.9 minus 8, which is the second year payment. So 0.9 is extra outstanding now. Here also 5.58 is extra outstanding. So at the end of second year, my loan liability will become how much? 95.83 plus 0.9. Right? 96.73 will become the outstanding now. Whereas in this case, this is what is the outstanding. The second year. So the balance sheet will move like this because these are the entries in the balance sheet. Loan liability is an entry in the balance sheet. Initially it was 95 and 70. At the end of first year it became 95.83 and 75.17. Second year it has become 96.73 and 80.73. Same logic you go for the third year. Interest expense 9.3 times the loan which is outstanding. Just get the hold on this. This is the interest for the third year. Same logic, 7.39% times this much. So, but what is the actual payment? 8 and 0. Actual payments are 8 and 0. So, there is a difference. This 0.99 is the difference here. Similarly, a whole 5.96 is the difference here. So again, loan liability. This time now the enhanced loan, the next at the end of third year, my balance sheet will show this much. And in this case, my balance sheet will show this much at the end of third year. Now fourth year, interest expense 9.3% times 97.93 And similarly 7.39% times 86.7. So the difference again, which is coming out, but you are still receiving 8 only, fourth year also. So this much is outstanding in the fourth year exclusively. Here also you are receiving only 0 even in the fourth year. Okay, so that is the difference. So again the loan liability in our case, what is it becoming? 97.7 plus this 1.0. So it is becoming 98.81 and 93.11. And finally, okay, the fifth year, the interest expense this much, right? 9.3% times this 90 whatever 9.18, correct? And here also 7.39% times 93.11. So now if I look at the difference, whatever the interest part is this only, whereas you are actually receiving 108. Here also the interest part is this, you are actually receiving 100. Now you see the loan liability 0, because you have received, loan is over, it's almost 0, negligible. Almost zeros. Even if you address it to some decimals, you adjust them to some decimal, both are zeros, because the whole loan got paid off now. This is equal to 0 liability. So this is what comes. So now what we need to understand is, every year the interest expense changes and the loan liability also changes. These are the entries that go into the balance sheet and the P&L each year. Now any number you have purchased, let's say instead of 95, if say you have purchased the bond at 105, whatever is that, last is 0 only. Whatever is the amount you have purchased at, so these are the entries that go there. Okay, the IRR is only 6.79% here, right? 6.79%. So this is the interest part. First year the interest part is only 7.13, but you are receiving but I am paying you 8 as a part of coupon, which means I am paying you excess. Excess means that loan liability should actually come down, right? The interest part is only 7.13, which is 6.79% times this 105, which is only 7.13. But I am paying you 8 in the first year, which means I am paying you excess. That excess should bring down the liability. The difference is negative. So typically the liability is coming from 105 to 104.13. So what we are saying is, the entries, interest as well as the maturity value, face value, or the loan liability on the balance sheet, they keep changing year over year. And this change year over year, this process where you compute the interest, find the difference and adjust it to the loan liability part, depending on whether it is higher or lower, either it is added to the loan liability or subtracted from the loan liability, and the loan liability is either increasing or decreasing accordingly. This is what is typically called as an amortized cost kind of a method, right? And here some of the things for us to remember. Okay. So after issue, anytime we want to find out the book value of the bond liability, there could be a question. Okay. At the end of 1 year, find what is the loan liability. So one way is I can find out the interest, I can find out the difference, all that stuff. The other way is find, see, after 1 year means these are the four things that are outstanding. These are the four things that are outstanding. Find the NPV of these four. Find the NPV of these four using this as the discounting rate. Use this as the discounting rate. Find the NPV of all the future cash flows. Let's say after 1 year, see, I want to find out, I want to get this number directly, right? Either I find out the interest, take the difference and subtract it and arrive at the lease liability. That is one aspect. If the question asks for interest as well as the lease liability or something like that, you can do this kind of a process. The other process is to arrive directly at this loan liability at any year. All we are saying is, if I want it at the end of 1 year, which means this is already over, this receipt is already over, this payment would have got received. So future means only these four payments are yet to be received. So find the NPV of these four using this interest rate. So if I am finding out the NPV of those four using this interest rate, let's see the NPV using this as the interest rate and only these four as the payments. 104.13. Right here also, if I want to find out, let's say after 2 years I want to find out, the same way NPV, you take it at this rate and only these three as the payments, because these are the only future payments at the end of 2 years. So if I look at this becomes 103.19, which is what is similar to this. So whenever I want to find out what is the outstanding loan liability directly, I can find out the present value of all the future cash flows discounted at IRR, the yield to maturity of the bond. Right? Even for this bond also, it's applicable for everything. Now here for this bond also, if I want to do the same, even if it is a zero coupon bond, it is applicable. This is the interest rate and these are the three future payments. 80.73 at the end of 2 years. This is equal to 80.73. So I can directly find out the loan liability, outstanding loan liability using this kind of a process also, without finding out the interest and then the difference and then adjusting. If the question is only about finding out the loan liability kind of stuff, because what is this loan liability? Yeah, if you want to close the loan now, close down the loan now, if I pay 80.73, I can shut down the loan. That is what we are calling as a loan liability. I mean, if instead of extending it for 3 more years, if I want to close down the loan, if I pay 80.73, that should be sufficient enough. That is what is the meaning of our loan liability part. Right? Okay. This is where we talk about two types of bonds, or probably three types of bonds. We talk about a premium bond, we have a discount bond, and we have a par bond. The difference is nothing but, if you see that the interest rate, if it is less than the coupon, or probably look at it the other way, coupon, if it is more than the interest rate, coupon is 8% here, 8% of the face value, that's where we wrote it as 8888. coupon, if it is more than the face value, or probably more than the interest rate, which is the IRR or the YTM. If the coupon is more than the YTM, we will say those kind of bonds as premium bonds. Why? They are sold at a premium to the face value. They are sold at face value was 100, but they are being sold at 105. They are sold at a premium to the face value. This is the linkage. Wherever you see that the coupon rate is more than the IRR or the annual interest rate, we see that the bond will be sold at a premium to the face value. Face value is 100, so that's where it is being sold at 105. Whereas this case, you see, if the coupon is less than the interest rate or IRR, it will be called as a discount bond because it will sell at a discount to the face value. And if the coupon is same as the IRR, coupon is same as the IRR. Look at this. Coupon is same as the IRR. You will find that bond as a par bond. So any question talking about a par bond, it means that it is already purchased at the face value itself. It is purchased at the face value. The investor would be receiving 8888 in 4 years and 108 in the 5th year. In those cases, probably the difference is always 0 and loan liability is always 100. It does not increase or decrease because the difference is always coming out to 0 itself. Because interest is 8% on IRR is 8%. So the interest expense is nothing but IRR times the outstanding amount, which is 8. What you are receiving is also 8. Difference is always 0. Difference is 0 means the loan liability is still maintaining at 100 itself. So in case of par bond, you don't find that the loan liability is either increasing or decreasing at all. It's constant at the face value itself. Interest is always 0. I mean, in the difference between the interest and the coupon payment is always 0. Interest expense is always constant. But for a premium bond as well as a discount bond, that numbers are differing year over year. So this is one thing you have to understand. So in case of a premium bond, just as I talked about, the coupon rate is greater than the rate of interest at the time of issue, which is nothing but the IRR or probably YTM. Coupon, if it is higher, so higher coupons generally result in being sold at a premium. Lesser coupons will always get sold at a discount. So 0 coupon bond always gets sold at a bigger discount because the coupon is always lesser than the interest rate. So it will always be sold at a bigger amounts of discount. So they are always reported at a premium on the balance sheet because first year you will show 105 or something on the balance sheet, but slowly it comes down to 100 because there is we always see, if you see here, if this is a premium bond, first year I'll show 105 on the balance sheet, but the interest for that is always less than the coupon. The interest expense for this is less than the coupon, which means actually excess is being paid always. So that will always reduce the liability. Year over year, the liability gets reduced and comes very close to the face value, right? Whereas in case of 0 coupon, or in case where the coupon is lesser, discount bond, you will see that the interest expense is always higher than the coupon. So the liability keeps increasing up to the face value. So on the maturity, It's always equal to the face value. So the face value minus face value always becomes 0. Once the face value is paid, it becomes 0. So that is what we say, whether it is a premium bond or a discount bond. The only thing is, in case of probably you should see that the loan liabilities will come like this. If it is a premium bond, let's say this is the par value, face value. If it is a premium bond, initially it will be shown at much higher the face value. As time progresses, it comes down and touches the face value. If it is a discount bond, initially it will be shown at much lesser than the face value. But again, as the maturity approaches, it comes very close to the face value. Whereas if it is a par bond, it's always on the face value itself. So this relationship, if you are able to understand, the accounting aspects of each of these things can very well be handled. This is the most important aspect as far as the reporting of the bonds kind of instruments is concerned. You need to just understand the concept of premium, discount, what entries go at the beginning, what entries are going at the end of each of the periods, what is shown in the P&L, what is shown in the balance sheet. Now, in the cash flow statement, every year 8 has to be shown, because in reality the payment is only 8, out of which what we are saying is whatever is the interest portion of it, the interest portion of this is shown as cash flow from operations, and the principal repayment or liability increase or liability decrease is shown as cash flow from financing. So in this example, 8 is the cash flow from total cash outflow, because company is paying 8. Out of that, 7.13 will be shown as cash outflow from operations, and 0.187 is shown as the cash outflow from the financing, because it is reducing the loan liability. Liability is coming down, so there is a cash outflow that is happening. Whereas in this cases, because the interest part is 5.18, the whole cash outflow from operations is being shown as 5.18. Cash inflow from financing is shown as plus 5.18, because overall the company is paying 0 this year. Real payment is only 0. But representation wise, how is it represented? It is shown as a negative 5.18 under operations, cash flow from operations, positive 5.18 under cash flow from financing, because liability has increased. Liability has increased, which means it's like we have seen, if any liability is increased, it's like a cash flow increasing. So though there is no 0 cash flow, the way it is represented as is minus in case of cash flow from operations and plus in case of cash flow from financing. Net is always 0. Right? Then, so this we have already talked about. Interest expense, let's see. Book value of the bond at the beginning of the period, which is the loan liability value, multiplied by the market rate of interest at the time of issuance. That same 6.79 or 7.39% is what we'll use every year. In case of premium bond, we'll see that the interest expense is less than the coupon payment. Right? That table which we have made, the difference is subtracted from the bond liability. In case of a discount bond, interest expense is always more than the coupon payment. We have seen here the interest expense is 5.18, whereas the coupon is 0. So interest expense is more than the coupon payment. Difference is always added to the bond liability. So this, if this kind of a grid is comfortable for you, you can almost answer every kind of scenario with respect to the bonds. Because after that, all that says is assets go up, go down, these kind of assessments. Okay, then one more aspect that we need to focus on here is derecognition of the liability, which is nothing but you are closing the bond before the maturity date itself, redeeming the bond, right? Buying back the bond. Buying back the bond, let's say it's a 5-year maturity bond, but the company may say, I'll buy it back after 2 years. There may be some provisions associated with those things, which we will discuss later. But assume that the company is buying back the bond after 2 years. It doesn't want to continue for 5 years paying the interest and the principal for 5 years. It wants to pay off the outstanding and it wants to close down the bond. So let's say after 2 years, the company wants to close out the bond. If this bond the company wants to close out after 2 years, actually it has to pay 103.19 because the outstanding liability at the end of 2 years is 103.19. The company has to pay 103.19, not 100. Face value 100 is paid only if it is closed on maturity. If it is closed anywhere before maturity, we have to really find out what is the outstanding loan liability for that at that time. So for the bond number 1, at the end of 2 years, the outstanding liability is 103.19. Whereas for this bond, the outstanding liability is 80.73. So if the company wants to close down the bond, buy back the bond, it does not want the bond anymore in the market, then it has to actually pay as per our books. This is the book value. As per our books, its value is 103.19. But in reality, the company, let's say, might have paid either 104 or 102. It might have either paid 104 or 102. So if it had paid 104, actually it should pay 103.19 only. So the remaining 0.81 is treated as a loss. It's not 4 which is treated as a loss. It is 0.81 which is treated as a loss for the company. Because as of today, it is supposed to pay 103.19 to close out the bond. But it is paying 104 now. To close out the bond, it is paying 104 to the buyers. For some reason or the other, it is paying 104 to close out the bond. So that remaining 0.81 is actually treated as a loss in the P&L statement of the company. No, because these bonds are again traded in the market. And the interest rates keep changing every year or every frequently. So if the interest rate, the way 103.19 is arrived at is based on the interest rate on the day of purchasing. But after 2 years, the interest rates could be either more or less. Because of that, the market price could be much higher or much lower. So typically when the company has to buy back in the middle, it may have to buy at a market price. Because these bonds generally get traded onto the market also. So that market price could be either more than the book price or less than the book price. Because of that, the company may either pay a more amount or a lesser amount to buy back the bond. So if it is paying more, it recognizes this 0.81 as a loss. If it is paying only 102, it recognizes 1.19 as a gain in the income statement. This is one thing which associated with derecognition, because the bond does not exist anymore. It's closed. The bond is cancelled. In that case, this is one entry that typically goes off. And okay, there is one small difference with respect to GAAP and IFRS, especially with respect to issuing costs. What is this issuing cost? See, initially flotation costs. when a bond is issued, there is a one-time cost, either some amount that is paid to the investment banker or for various administrative and expenses that are incurred one time at the time of issuing of the bond. What the US GAAP says is that cost, that flotation cost, you can amortize over the period of the bond. Though you are incurring, let's say, $1,000 at the time of issuing of the bond, the US GAAP says probably you put 200 for the next 5 years. Whereas IFRS, what it is simply saying is don't treat them separately. Bond costs and bond issuance costs. See, in case of US GAAP, the bond cost and bond issuance cost both are treated separately. Whereas in case of IFRS, both of them go into the price of the bond itself. So because of this, what is saying is if the bond is closed in the middle, even the bond issuance costs might not have got fully allocated, right? So even those costs, identify and book them as a loss because you have not allocated those costs till today. So that should reduce your gain. Whereas in case of IFRS, because the bond issuance costs are directly taken care into the price of the bond itself. So there is, it's like this. Probably better way to understand is, let's say if 2 is the bond issuance costs, right? What we may say is 107 I will put as the price of the bond as per IFRS. As per IFRS, if let's say the the initial costs are 2, the flotation costs are 2. What IFRS says is put 107 as the first year's price of the bond. Though you have purchased it at 105, if 2 is the flotation cost, add it to the initial and probably put 107, and after that you do this process. Whereas what GAAP says is put it as 105 only. 2, take it as a separate expense. 2, take it as a separate expense and spread that separate expense over the period of the bond. Probably 0.4 for the 5 years. So after 2 years, if you are closing down the bond, 1.2 is still left to be allocated. So that 1.2 also should be reduced from your gain or increased to your loss because you have not spread those costs. Whereas IFRS, it has taken them into the price itself. So in case of US GAAP, let's say this at the end of second year, it is 103.19, right? And probably let's say the flotation costs are 2. So 2 means 5 years if it is spreading 0.4, 0.4, 0.4 for 5 years. So at the end of 2 years, it has allocated only 0.8. 1.2 is yet to be allocated. So what we are saying is 1.2 plus 103.19 is the total amount that has to be paid. Total liability that has to be paid is 103.19 plus 1.2. So probably 104 point whatever. So if 104 only is being paid, 0.39 has to be absorbed as a loss. Whereas in case of IFRS, this is not 105 anymore. This is taken as 107 directly. 2 cost is also taken care into this. So actually it should be 104.45. So if the company is paying only 104, book the minus 0.45 as a loss. Right? The only thing is difference in the headings. They have 2 different headings, one for the bond costs, 2 for issuing costs in case of GAAP. In case of IFRS, both are taken together and included as a part of the cost of the bond itself. So, yeah, typically every bond will have some kind of covenants. So, see, there is something called indenture that is associated with a bond. Indenture is more like a prospectus. Every bond that is issued will have a prospectus. And that prospectus will contain something called as covenants, which are like do's and don'ts for a bond issuer. What all should this person do? What all should this person not do? Let's say I'm raising a loan, right? I raise a loan, and when I'm raising, probably my lenders will put some kind of restrictions on me. Those restrictions are what we call as covenants, and they are mentioned at the time of issuance of the bond itself. Some of the most common things are, okay, you should not pay dividends more than this much to your shareholders. Because if more dividend is paid, there is a possibility that next year the growth will be lesser for the company. The profits may be lesser, which could result in the company inability to pay the interest. Right? Because the interest is paid out of the profit itself. So what they say is, you can't give a dividend of more than this much. Or you cannot buy out some other firm without our knowledge, without our approval. As a lender, you will put all these restrictions on me. Because if I buy some other company, generally I'll pay a huge cash to buy that company. So my cash reserves will go down. And it may so happen next year I may not be in a position to pay interest for you. So because of that, they put all these kind of restrictions. Disposal of some assets. You don't sell off all these major assets without our approval. If you sell off, your growth is coming down. The size of the company is coming down. So the interest, again, the payment capability will actually go down. Or no new borrowings. If you borrow more, probably they will put some more restrictions that we should get a priority in the payment. So because of all those things, again, my payment will get affected. Or they may always say, you have to maintain some level of ratios, current ratio at this level, probably interest coverage ratio at this level. Some such kind of restrictions also may come up. So these are some of the things that are associated with the bond. And for every bond that is being issued, in the footnotes, all these details have to be mandatorily disclosed. Right? What is the period of the bond? When are they maturing? What is the IRR associated with each of them? Right? How much coupon is being paid? Can it be bought back in the middle? If it can, that is the call provision. Can it be bought back in the middle? If it can be bought back, at what price can it be bought back? Can it be converted into a share? Is there a convertible provision that is associated with the bond? What are the covenants that are present on that bond? What are the restrictions that are present on each of the bonds? And what assets are being pledged as collaterals for the bond? And also talking about which bonds are maturing in each of the next 5 years. How many bonds are maturing in each of the next 5 years? Because principal payment has to be made when a bond is maturing. So if it is a principal payment, it's a sizable cash outflow that happens. Whenever a company has to make a principal repayment, it's a sizable amount that is going out. So the cash flow becomes more and more worse at that point. So from that standpoint, all these disclosures are very heavily used by the analyst in doing the valuation of the firm, as well as the valuations of the bonds are probably used in credit analysis, all these kind of scenarios. Then the next aspect we are moving on to as a part of this liabilities is the leasing part. Sometimes the companies, what they do is, instead of buying an asset, they lease it. Buying a building, they lease it. Right? There are some advantages. One, it's a low cost financing. Because if I borrow, probably I may have to pay at 12% or 15% every year. But I may lease it at a slightly lesser percentage also. We'll talk about how it goes down. Leasing is as good as a renting. Slightly different from renting, but it is as good as a renting again. And it reduces the obsolescence risk. Probably if I buy a building, Even if it goes old, I may have to bear with it. But if I have leased it, I don't want after 5 years, I'll move on to a new one. So that's the kind of a benefit that exists with leasing, and restrictions are much lesser. So what we are saying in case of lease, see, it's like this. Let's say I want to buy a machine, right? I want to buy a machine. The cost of the machine, instead of buying it directly, what I may say, I will lease the machine. And as a part of the leasing, I may say, okay, I'll pay 15,000 every year. I'll pay 15,000 every year for 5 years. You give me the machine. It's like an installment purchase, right? I'm taking a machine from you, right? But I'm not purchasing it. I'm leasing it. As a part of this lease, it's as good as one. It could be treated as a rental, right? Or it could be treated, we will talk about two different kinds of leases, but it's as good as I'm paying some amount every year instead of a lump sum purchase today. I'm not paying probably 60,000-70,000 bucks today and purchasing that machine. I'm paying on an installment basis like this. This is what we are calling as leasing part. In this leasing, we have two major types. One is called as a financial lease, or sometimes people call it as a capital lease. Either financing lease or a capital lease. See, today, if I'm purely renting, even the buildings which we see here, they'll say lease or rent, right? If I'm renting it, what it means is I'll pay a rental every year, and the ownership never comes to me at any point. I'm only a temporary user of that particular property, and whenever I want to vacate, I can vacate it. Everything like tax payment and all the other things lies with the owner itself. That is a typical renting kind of a scenario. But so that is what we call as operating lease. The word rental is nothing but operating lease. So if at all there is a possibility of the transfer of ownership. If my landlord says any modifications you want to do, it is your cost, right? Any modifications you want to do, or any other damages that come, any taxes that come up, everything, it's as good as you are the owner of the property now. When I have leased the property to you, when I have leased the equipment to you, now the right of ownership and risk of ownership both, now you are the owner for that building. I will not come and interfere at all. As long as the lease agreement exists between both of us, you will be responsible for all the headaches associated with that building. So rights and risks, both of them are transferred to the tenant. We call that as financial or capital lease. Otherwise, we call it as operating lease. In operating lease, it's only a rental payment. That's it. All the risks, right, everything exists with the current owner itself. That is one aspect. As per IFRS, the definition is as simple as that. When the rights of title and ownership are transferred to the lessee. Lessee is the person who has taken the lease. Lessor is the person who has given the lease. This term also we should be comfortable with, right? Person who has given the lease, who is the owner and who has transferred the right, we call him as lessor. Who is the tenant and who is taking the lease rights, we call him as lessee. So when all the rights and risks, both of them, any damage comes, any modification to be done, it has to be done by the tenant or the lessee itself. That is what we call as the financing or capital lease. Otherwise, if it is purely a rental kind of an agreement, we call it as an operating lease. Whereas US GAAP has made the identification of financing lease slightly complicated. Apart from title transfer, it is also saying if any of these criteria is met also, it will treat as a capital lease only. Which means, okay, let's say we are talking of 20-year lease period. We are getting into a 20-year lease agreement. So at the end of 20 years, if the property belongs to me altogether, right, for this 20 years, I'll pay you some kind of a lease amount. But after 20 years, when the lease agreement is over, the title permanently with me, then we call it as a financial lease. Because in some deals that is generally possible. We'll sign a 20-year lease agreement. For this 20 years, you keep paying me this much. At the end of 20 years, the property will belong to you. Even then, we call it as the financial lease itself. And if the lease agreement says there is a bargain purchase option, whenever you want to buy it off, there is a possibility that you can buy it. Let's say after 5 years, after 10 years, we can negotiate on the buying of the property. Then also, if such clause is there in the lease agreement, even then, GAAP says you have to treat it as a financial. Like every year you pay me this much rent. At the end of 5 years, if you want, we can negotiate on the purchase of the property altogether. Or the most important criteria being the leasing period is 75% or more of the useful life of that asset. Building, let's say it is assumed that the average life of the building is 20 years. Right? If we have signed a lease agreement of 15 years or more, which is 75% of the useful life of the building. If we have signed a lease agreement for 15 years or more, whether it is an operating, you are just a rental payer also, what it says is you have to treat it as a capital lease itself. And if you have signed a lease agreement for at least 75% of the years of the useful life, or whatever the lease payments you are making, the present value of all of them, like here you are paying the lease payments of 15,000 over the next 5 years. What is the present value of all of them? Let's say I'm taking it at the rate of 8%, right? So the present value at the rate of 8%, the present value of all these payments is how much? Around 59,000, right? Let's say if the cost of the building is 60,000 or 62,000. If the cost of the building is 62,000, now how much I'm paying altogether? I'm paying almost 97% of the cost of the building. 96.6% of the cost of the building. So anything above the 90% of the cost of, let's say if the cost of the building is 80,000 bucks. If the cost of the building is 80,000, then I am paying only 74% of with these kind of lease payments. I am paying only 74%. Then I can treat it as operating lease itself, provided no other criteria match. If any of these 4 criteria are existing, any one of the 4 criteria is also existing, you can very well treat it as a capital lease or a financing lease. Only otherwise you will go for an operating lease. Now, how do you represent each of these things as a part of your financial statement? In operating lease, straightforward, no issues. Because from a lessee standpoint, he is only making a rental payment. From a lessee standpoint, if we see, it's just a rental payment, nothing else. So what happens from a lessee standpoint? It comes as an expense in the P&L statement. In the P&L statement, so you see operating lease, it's a rental agreement basically. So expense is shown, whatever is, if this has been an operating lease saying for the next 5 years, you have to pay me 15,000. I'll give you this building on rent. Let's say I sign a agreement with my owner saying you pay 15,000 per year for the next 5 years. First of all, it's not a financing lease, because I mean, at least from this criteria, I'm paying only 75% of the value of the present value of all my payments is only less than 90% of the total price of the asset, and assuming that all other criteria are also not met, like title transfer is not there, no bargain purchase option exists, or the useful life is also, let's say, 10 years, whereas I am leasing it only for 5 years. It's not even 75% of the total useful life. So if it is an operating lease, the entries are simple. This 15,000 will be shown in my expenses in my P&L statement. For a lessee, it will be shown as a revenue, other income kind of stuff, or a lease revenue. Lease revenue kind of stuff is being shown from a lesser standpoint. Nothing else, because the transaction is only 15,000. No ownership, no transfer, nothing. Right? If you want to vacate, you will vacate. There is nothing else, no transfers, nothing existing. So the entries are very simple. From a lessee standpoint, an expense of 15,000 is shown in the income statement, and lesser standpoint, a revenue of 15,000 is shown in the income statement. Only that much. So because you are paying 15,000, your cash flow statement will show in the cash flow from operations, a negative 15,000 going into the cash flow from operations. So even the cash will come down by the extent of 15,000, nothing else. But if this same is being treated as a financing lease, this is where the whole concept changes. When we are talking of this same as a financing lease, we have seen that the present value of all the future payments is 59,890. So now let's say, what is the purchase price of the asset? Let me say this purchase price of the asset is 80,000. Right? If the purchase price of the asset is 80,000 and I'm selling it to you, if the purchase price, probably I'll take it the other way. If the purchase price of the asset is only 50,000, now let me make an assumption that the asset, it's a capital lease, which means after this asset is a scrap. After this, I'll say that this asset is a scrap. So the actual price of this asset is only 50, but the way I'm charging the payments from you is at the extent of 15,000 per year, which the present value is working out to 59,890, which means the difference between the two is an immediate gain. This 9,890 is booked as a gain by the lessor. It is booked as a loss by the lessee. Right? Because the actual transaction is 59,000. Right? Whatever the lease agreement we are signing, I'm supposed to pay 59,890 to you. But the actual price of it is only 50,000. Right? So from a lesser standpoint, this is booked as a gain, because he has actually his cost is only 50,000, whereas he has sold it. It's virtually like he has sold it to you at 59,000. Instead of receiving 59,000 in one single go, see, look at it like this. Okay, I have purchased an asset, right? Let's look at it like this. I have purchased a machine for 50,000. All right, I have purchased a machine at 50,000, and the moment I have purchased it, I have leased it to you, right? And so, logically speaking, when we talk about a financial lease, it's as good as I have resold it to you. But instead of taking the money in one single go from you, I am taking it in the form of lease rentals. This is the definition of a financing lease. I have purchased an asset, right? I have purchased a machine for 50,000 and I am reselling it to you. Financing lease is as good as selling. The only thing is, instead of receiving the payment one time, we are receiving the payments in different intervals of time, right? Because title, transfer, everything is happening to you. So it's as good as I have purchased it and I am reselling it to you. Now my purchase price is 5,000, whereas I am selling it to you at 59,000. Instead of receiving 59,000 in one single shot, I am receiving 15,000 from you for the next 5 years. That is the meaning of this, right? So what, from a lesser standpoint, this whole 9,890 is being booked as a profit. Whereas from a lessee standpoint, his cost is 59,890. So in the initial first year, okay, now 0, 1, 2, 3, 4, 5. 0th year, which is the day on which he has purchased the asset. So asset as well as the liability. Asset as well as the liability. So what is the asset here? Because it's as good as he has purchased the machine, right? If I have leased it to you, it's as good as you have purchased the machine. So your fixed assets, which is the machine, tangible asset, will increase by 59,890 the first year. I mean the 0th year, on the day of purchase. Your assets will increase by 59,890 because it's as good as you have purchased it. Lessee. For a lessee, it will increase by 59,890. And similarly, the liability. What is the liability? Lease payable. Lease payable also will increase by 59,890. Overall, I have to pay that much to you, right? I have taken a machine, but I have to pay 59,890 to you. So these are the two entries that go on the day of purchase. Where is this 59,890 coming up? The present value of all the future cash flows discounted at some rate of interest. Right? Now, from the first year onwards, look at it like this. Now this is your asset. Now you are having a machine with you. Assume that the life of the machine is 5 years. You can take a depreciation because now you are the owner of that asset. Owner of that asset means you have to spread the cost of it. So typically from the first year onwards, actually depreciation gets applicable in your P&L statement. What is the amount of depreciation? Probably if I am saying this is the total worth of my asset, 20% of it I'll take every year. So my depreciation expense will come out to the same amount for 5 years. So the same cost, see, any asset, what do? We spread the cost of that asset over the period of the asset. We are saying that for simplicity reason, if I am saying that the asset's life is only 5 years, I have purchased it and leased it to you, which means at the end of 5 years that is scrap. So now you are the owner of the asset, so you have to depreciate that cost of the asset. So the first thing corresponding to this asset, there is a depreciation that gets created each of the years. That is one entry. The second entry is, now this is a lease payable of 59,000. There is an interest that gets applied on that every year. Okay, so the lease interest that gets applicable. In the first year, how much is it? Whatever is 59,000 multiplied by 8%. Whatever is the interest rate. So the lease interest part of it is around 4,791 for the first year. But how much are you paying? The actual payment is how much? In the first year, what is the real payment? 15,000 is the real payment. In the first year, 15,000 is the real payment. So the difference, actually the interest wise you should pay only 4,791 for whatever the lease value, right? If you have borrowed 59,890 at 8%, the interest part is only 4,791, but you are paying 15,000. That excess whatever you are paying will reduce the lease payable part, just like the bond part. Right, whatever, so the difference, whatever you are calling as the difference, which is actual interest minus your payment, how much you are paying. So you are actually paying 10,000 extra. So what we are saying is, in the year 2 or the end of year 1, your lease payable will actually become this much, 49,000 only. Because you are paying 15, out of which only 4 is going towards interest. The remaining 10,200 is going towards the principal repayment kind of stuff. So your lease payable is actually coming down to 49,000. So now just doing the same strategy again. So for your second year, what is the interest on this amount? 8%. Because you have paid some portion of the principal. Now outstanding part is only 49,000. So on this 8% is the interest. 3974 is the value of the interest. But you are still paying 15,000. Right? Every year you are paying 15,000. So again the same logic, the difference. So which means around 11,000 is what you are contributing towards the lease repayment. So which means again the same logic, your outstanding at the end of the second year is becoming 38,000. Now the same way you continue, the liability will get decreased. The same way you continue for the whole 5 years. At the end of 5 years, the whole liability is getting closed down. The same way we have applied to the bonds. But each of the years, now here, so these are the entries. We have to be very careful about what entries come up. See, for corresponding to the bonds, we talked about the entries like interest expense, the difference going into loan payable or the bond payable, bond liability. Whereas here, from an asset standpoint, okay, now what is the value of the asset each of the period? I have to remove the depreciation for each of the years. That will be the entry in the asset. Okay, so I'll remove the depreciation. So my asset also will become 0 at the end of final. So initially the asset got increased by 59,000, liability got increased by 59,000. After the lease period, asset is increased by 0, liability is increased by 0. Again balancing. But in the middle they are not balanced. Asset, the value of the asset is 47,000, whereas the liability is showing 49,000. Where is the remaining amount going to? Because at the end, assets and liabilities should balance. Now if you see, what is the actual expense here? Depreciation is 11,000. and lease interest is 4,700, right? So what is the total expense here? The total expense, these two go into P&L only, depreciation as well as interest. So actual payment should have been 16,769, but you are paying only 15,000, right? From a payer standpoint, I'm paying, see, the depreciation is 11,000, lease, so the total expense is 16,769. 16,769 is the expense. So, whereas here what we are seeing is the expense is actually 16,769. So, if I had gone for you see the difference between the payment and this? The difference between the payment and this is to the extent of 1,769. And you see the difference between the asset and the liability is also exactly 1,769. That is the adjustment that is coming up. The assets and the liabilities mismatch is compensated between what you are paying in terms of cash, because from a cash outflow standpoint, your assets are getting reduced only by 15,000. The cash as an asset is getting reduced only by 15,000, whereas here your asset is actually getting reduced. What is the actual reduction in the asset? Only 11,978. Only 11,978 is the reduction in the asset. So the remaining is being compensated by the difference. So this is what is the adjustment that typically goes as far as, so every year you will see the difference here will match with the differences here. The difference, what did we take here? Difference between the asset and this. Here, depreciation plus lease. Okay, this is what, okay, this is the depreciation. The lease amounts are getting reduced by this much. You see here, if you typically look at the differences each of the years, this will exactly, if you look at the differences each of the years, this will exactly match up to these numbers. So that is what is the adjustment that is coming up as a part of the liabilities. So simple scenarios are, in case of leases, the entries are on the first year at the time of leasing, both the assets as well as the lease payable, which is the liabilities, are getting increased by the same amount, which is the present value of the future payment. And coming to the assets, there is a depreciation that is applicable, and corresponding to that depreciation, the asset value keeps reducing. Coming to the liabilities, the lease payable, there are two aspects in that. One is the lease interest payment. The second one is going towards the reduction of the lease payable based on the actual payment that has been made. The second is going towards the adjustment of the lease payable. So what we are seeing is, in the initial years, in the first 3 years, the expense, which is the sum of depreciation plus interest, is more than the actual payment that you are paying. This is actually more than the payment which you are making. Which is what is resulting in your liability more than your asset. See, you are paying, you are supposed to pay 16,000, but you are paying only 15,000. So the remaining 1769 got added up to your liability, which is what has increased your liability by the extent of 1,769. Similarly, in the second year, your total expense is 15,952, but you are paying only 15,000. So the remaining 952 is still adding up to your liability, which has taken your increase. The difference has increased to 2,722, which is nothing but 1769 plus 952. Whereas in the third year, the excess, the shortage which you are paying is 70. So liability should even increase more by another 70. In the fourth year, your liability, your expense is only 14,118, but you are still paying 15,000. So you are paying an excess of almost 880. That should reduce your liability by 880. So that is where from 2,792, which was your outstanding liability, if I remove 881, it has come to 1,910. The same logic, in the final year, you are actually, your expense is only 13,089, but you are still paying 15,000. So you are paying almost an excess of 1,910. The deficit. Total should be equal to 0 itself. So if you try to match all these numbers, 75,000, which is same as 75,000. So only thing is the timing is different. Initially, now those are what are the analysis part. Initially what you see is the expenses are high in case of capital leasing compared to operating lease. In operating lease, only 15,000 will be shown as expense. Whereas in a capital lease, higher amounts will be shown as expense in the initial years. In the later years, the expenses will actually go down in the P&L. So accordingly, you have to think through, okay, profits. Initial years, profits are lesser in case of a capital lease compared to operating lease. These are the analytical points you have to be comfortable with. But if you understand the flow overall, couple of things, okay, in a capital lease, assets and liabilities, both of them are going up. In operating lease, no entry into the balance sheet, so no change in the value of the assets. Whereas in case of operating lease, the assets as well as liabilities both go up. So from that standpoint, ROA will come down. Return on assets. Assets are going up, so ROA should come down. Such kind of understanding you need to develop in terms of evaluation. Because the simple logic, the moment you understand what goes up, what goes down, all the ratios and everything, you should plan out accordingly. Every entry of the balance sheet, every entry of the P&L, you should be comfortable with, okay, will this entry increase the profit, decrease the profit, increase the, which all get increased, which all get decreased because of this entry. And because of that, what ratios are up, what ratios are down. Such kind of analysis should come out for each of your tasks. Fine. So from a lessee's standpoint, those are what are the scenario, and from a lesser standpoint, he reflects the opposite side of it. Yeah, if he has again as a term wise, if it was 50,000 and he has sold it at 59,000, right? Such where 9,000 is being recognized as a gain by the lessor, such kind of a lease agreement is called as sales type lease, because he is leasing it with an intention of selling. Profit. There is some profit that is going into the leasing part. So that's where this kind of a lease is called as a sales type lease. where the present value of all the lease payments is greater than the cost of asset. Whereas otherwise we call it as a direct financing lease, which means there is no sales motive, there is no profit motive in that. Whatever is the cost, the present value of it means like probably it costed me 59,980 and I'm collecting 15,000 from you for the next 5 years. So the present value of the lease payment is equal to the cost of the asset. Then we call it as a direct financing kind of a lease. In direct financing lease, there is no possibility of a gain. Whereas in case of sales type lease, there is always a possibility of gain, because what you are charging, the present value of your charges from the customer, from the lessee, is more than the cost which you have incurred to purchase that asset. Those are called as a sales type lease. And the simple logic is, wherever the interest related payment is there, it goes into cash flow from operations. Wherever the lease payable related stuff is there, it goes into cash flow from investing. From a lesser standpoint, it's as good as he has invested in the person. From a lessee standpoint, it goes as cash flow from financing, whereas from a lesser standpoint, it goes from cash flow from investment activities. And corresponding to the leases, there are some disclosures which both lessee and lessor, both of them have to disclose in their financial statement. The clean details of the lease agreement, which talks about how long is this lease, how much amounts have to be paid each year as a part of the lease, and at least in detail for the next 5 years. Each of the next 5 years, how much payments are to be made. After 5 years, probably they can be aggregated, saying from 6th year onwards, the total payments are this much. But at least for the first 5 years, next 5 years, every year wise, how much payments are to be made have to be clearly detailed out. And whatever are outstanding from various lease arrangements, and whatever are the restrictions that are imposed, covenants, even a lessor can impose a covenant. So what are any other aspects associated with the leases, even they have to be disclosed as a part of the lease agreement, or as a part of the footnotes in the financial statements. Then the third aspect that comes into it is just an introduction to this space of pension plans. Right, the details of this are covered as a part of the level 2, where all the mathematical calculations of the pension related stuffs and all, we have a separate chapter on pension plans as a part of level 2. But here it's just an introduction, where if we typically look at pension plans, again there is a lot of similarity between leases and pension plans. Just like we have an operating lease and a financial lease, here also we have two terms called a defined contribution plan and a defined benefit plan. In a defined this is, see, just like probably you can draw the similarities, like when I look at lease, probably it's payment to a person who has sold the asset, right? Or probably to the owner, real owner, the payment to the real owner. When I am looking at pensions, the payment to the employees. That's the key difference. Now, in a defined contribution plan, what the companies generally do is, they just say some portion, there is some externally managed pension fund, EPF or some such kind of pension fund will be there, and the company will contribute some fixed amount to that. Okay, 10-12% of the basic will contribute to that fund. So we don't promise how much you will get on retirement. Let's say you are my employee, right? As long as you are my employee, I will contribute some percentage of your salary to a pension fund. Someone else will manage that fund. They will do the investments part of it. So as a company, I am not bothered about how much pension you will receive on retirement. So that is a defined contribution. The company's responsibility is only contribute some money to some external agency. It does not do any kind of investment activity of that money. They are called as a defined contribution plan, as simple as your operational risk. Operational lease. Every month or every year, I pay some fixed amount. Nothing more than that. No other responsibility associated. So, how much will come on retirement? The employer does not take any kind of a risk about it. His role is only contribute some amount to that fund, and those fund managers will have to decide how to invest and probably how much to be given on the retirement of this person. Whereas nowadays we are seeing even a lot of defined benefit pension plan, which means company will take care of paying the pension as long as the person is alive from the date of retirement. This is the amount we will pay you every month. So company is taking care of the retirement part. It's not it's just, see, it's as good as, okay, there is a pension fund managed by some ICICI Prudential. What the companies may say is, okay, we'll contribute some 10%, 12% of your basic salary to that fund. You'll have a pension account opened with ICICI Prudential or some ex company. We will contribute 12% of your basic there. That's it. As long as you are my employee, I'll contribute 12% of your basic to that fund. Now, the fund managers of ICICI Prudential will have to take care of how to invest, how much to get out of it, and how much to give to you once you retire. That is called as a defined contribution plan. Whereas defined benefit plan, what we are saying is, the company itself will take care of the investments part. And what the company does is, it will assure you some amount. We will pay you this much per month on retirement. On your retirement, we will pay you 20,000 per month. Now, it's the responsibility of the company. It's not contributing 12% of the basic anyway. It has to manage its own fund. It has to manage its own fund, invest them, get more better returns, so that once the person retires, he is paid as long as he is alive. Those kind of plans are called as a defined benefit plans. So, in the defined benefit plan, we are not talking about contribution every year. We are talking about the pension to be paid every year. The outcome is known. The outcome is known in a defined benefit plan, whereas outcome is not known in a defined contribution plan. I'll put only some money. So, as good as a operating lease. Whereas when we are talking about a defined benefit plan, company is taking the whole responsibility of payment until the person is alive from the date of retirement. That is called as a defined benefit plan. So, because the benefit is defined, how much benefit would be paid on the retirement of the person, that is defined. So, the employer will take care of the investment risk. It's the job of the employer to invest them properly, get a better money, so that he can create some profit out of it also. The returns, whatever he is getting, should be more than what he has to pay as a pension to the employee on the retirement. So, whatever he is investing, that is what we call as a plan asset. For that pension plan, what all investments he has done, they are all the plan assets. Whatever is the total value of that investment is greater than the estimated obligation. Estimated obligation is, okay, as of now, how much pension I have to pay to him. How does he compute? There are so many complications in the computation, assuming what is the lifetime. Okay, average lifetime of a person is some 75 years or 80 years. So, so the retirement period is 60 years, assuming the person is alive for 20 years on an average, right? So, assuming that he is alive for 20 years on an average, and per year will pay this much. So how much money has to be pulled up as of today and invested as of today to accommodate that much money. So for each year, the obligation keeps changing. So what we are saying is, if what the company has invested already is more than what has to be paid to the employees on retirement, we are that excess is what we are calling as a net pension asset. Otherwise, we are treating it as a net pension liability, the difference between the two. And whatever each year the difference that is getting created. So last year, let's say the net pension asset was 3,000, right? But this year the net pension asset is, let's say, 4,000. So this 1,000 is what we are treating as comprehensive income in the P&L statement. This is one more entry that typically goes up. Another entry that comes up is the pension expense. Every year, what is the expense for the company with respect to the pensions of the employees? Let's say we have 50 employees. What is the expense corresponding to all the 50 employees for that year? For that, what we are saying is, okay, service costs. Service cost is nothing but probably, okay, for each year the employee spends with the company, we will pay 1% as a pension. Some such kind of agreement will be given by the company. See, how much pension should be paid to you on your retirement. The company may say, okay, if you put 1 year of service with us, we will pay 2% of your salary as the pension. If you put 2 years of service, we will pay 4% as the pension. If you put 20 years of service with us, we will pay 40% of your salary as a premium, as a pension. Some such kind of thing could be there. So that is what we are calling as a service cost. And even there could be an interest income that can come up because you are investing your assets. So there could be an interest related stuff that is coming on that. All these things are going as a part of the pension expense under the IFRS. Whereas in case of US GAAP, apart from these costs, even the expected return on the plan assets, which is nothing but you are investing some amount, and if you are expecting 10% return on them, whereas the liabilities are at the rate of 8% itself, then that 2% is also being treated as a part of your income that is coming out in each of the years. And the same thing in case of a defined contribution plan, nothing. Very straightforward accounting entry. Because in case of defined contribution plan, whatever the employer is contributing, that is the expense. That's it. Every year, some 8%, 12% of the basic of the person is contributed. It's a straightforward. But in case of defined benefit, because the company is managing all of them, it has to treat each like other comprehensive income. It will look at the actuarial gains and losses. What is this actuarial gain and loss? Probably suddenly in the middle, let's say the life expectancy changes, right? Probably some medical improvement comes up, and now the life of a person is not 75 years. Now the average life is 80 years. Now the company has to make allocation to that, because pensions meaning is until the person dies, he will receive the payment. Now if the average life has increased, the company's contribution should increase. The company's investment part should increase. They have to contribute some more funds for investment. That excess funds that they have to contribute because of the change in the mortality, change in the life expectancy of the person, is coming into the actuarial gains. These are being represented under the other comprehensive income, and they are amortized over the income statement. As far as the pensions is concerned, understanding the difference between a defined benefit pension plan and a defined contribution pension plan and making the adjustments accordingly is the key aspect in the financial statements. So once these are done, As far as the liabilities are concerned, what are the various things we will look at? Liabilities play a very important role in the leverage ratios, because debt to equity, to debt to total assets, debt to total capital invested, equity plus debt, right? Or even the financial leverage. If you see the measures of leverage chapter, total assets by total equity. That is also, so the debt or the liabilities help a lot in computing the leverage ratios, which help in deciding the solvency of the company. And similarly, there are some coverage ratios which are purely coming from the balance sheet as well as the P&L statement. Or coverage ratios are primarily from the P&L statement relating to the long-term liabilities, interest, EBIT by interest, which is the interest coverage ratio, which we have seen as the solvency ratio earlier. Similarly, if there are leases, then probably to the numerator and the denominator, I'll add up the lease payments, which is called as a fixed charge or fixed charges, because lease payments are also like kind of interest payments itself. So the lease payment also getting added up, the whole thing is contributing to the solvency of the company. So using these set of ratios, we can assess the solvency of the company. So the liabilities part, from an analyst's perspective, the usage of the liabilities part is primarily to assess the solvency of the company.